Good afternoon, everyone. Welcome to the webinar on What is My Business Worth? Well, it's definitely been confirmed that this webinar on valuations has been definitely the largest turnout to date that we've had. I notice a few people still haven't gotten on, but they'll join us. Today we're going to be discussing the reasons for having your business valued. We're going to be comparing Main Street valuations, as we call it, versus mergers and acquisition valuations, which most of us call it M&A valuations. Also, Darren Mize will discuss what determines the value of your company, as well as the different valuation methods used when valuing. I'm Joan Young, the president of Sunbelt Business Brokers, and joining me today is Darren Mize of GCF Valuations. Good morning, Darren.
Good morning, everybody. It's a pleasure to be with you.
Great. Just to let you know a little bit about Darren's background, he's the senior partner and has over 20 years experience doing business valuations for GCF. And GCF is a full-service business valuation firm in Tampa, Florida. And we at Sunbelt have been working with GCF since we opened our doors 18 years ago. And by the way, GCF Valuations has been endorsed by the IBBA, which is the International Business Brokers Association, which speaks volumes for the quality of their work. Just a quick intro on Sunbelt. Our office is part of the largest business brokerage network with over 185 offices worldwide. We are based in San Jose, California, and have been helping buyers and sellers throughout the Bay Area and beyond for over 18 years now. And prior to starting Sunbelt, I owned FranNet of the Bay Area, which is the largest franchise consulting firm in North America. FranNet helps buyers to find the right new franchises. I sold FranNet over 4 years ago while I'd had it managed by others for many years. By the way, at the end of the webinar, we will allow time for Q&A, so you can enter your questions at the bottom screen that will come up when we start. And we're going to cover just as many of your questions that's allotted in the time frame we have. But if we don't get your questions answered, please feel free to call Darren or myself for more information, and we will have our numbers and email address at the end. So I've put your phones on mute so we won't be interrupted by ringing phones, etc., and we'll unmute that when it's time for questions. So let's get started, and I'll turn it over to Darren right now.
And Joan, you want me to control the slides?
Yes, go ahead.
I assume you do. Okay, great. So I think, as Joan mentioned, the purpose of our discussion today is to help everybody get a better sense of not only why is it important to value your company, but really what role valuation plays in the process of determining the value for different types of buyers that may be interested in your company, the types of value drivers that contribute to the overall value of a company. As an appraiser, I'll take you through a quick and brief summary of valuation methods that appraisers will use to value a company. And then we'll talk a little bit about valuations for market versus valuations for SBA lending, which is a prominent resource of all small business borrowers and sellers around the country, as SBA is very prominent in assisting small business owners with loans and their capital needs. So in the next 30 to 45 minutes, you should get a very good, solid understanding of how all this works and how it may or may not apply to you. When we look at the next slide here, the one thing that people have a hard time understanding is, or at least getting to a grip on, is that there are different types of valuations for different purposes, and everybody has their own need for valuation. It isn't necessarily just for selling a company. It can be used for a variety of different other purposes. In many cases, there's a need for business owners to just have a general benchmark as to exactly what their business is worth now, so that they can make an informed decision as to how they want to proceed looking forward, either in one, selling, two, gifting, 3, doing some kind of partner buyout or partner sale. The benchmarks gives you a better sense of where the value is today, as opposed to where it may be in the future, or you would like it for it to be in the future. So it's not necessarily just for selling, but obviously the primary purpose of evaluation, if in fact you're looking to go into market, is to establish a fair market value of what the company is worth. But it at least gives you a good sense of where you are now versus where you'd like to be, if in fact the valuation comes in below where you thought it might be worth. I think, in my opinion, the main purpose of having a valuation, first and foremost, is to help set an expectation. And the reason why I say that is because that many individuals out there, especially business owners who have been doing this for a long time, tend to get their own interpretation of what they think the value of their company is worth, or that value has been set by somebody else, whether it be a CPA, a friend, a spouse, a family member, etc. So lots of times valuations end up coming back with a value that is far different than what you may be expecting. So my only advice as part of this process is, if you're going into a valuation for a specific purpose, keep an open mind as to what that value may represent when you get the preliminary report, because it very well, in fact, may be different from what you thought it was. The one thing I do suggest always, especially if you're going into this process long term, is to make sure that you keep that valuation updated, because once you get past about 12 months, the valuation becomes stale. Theoretically, it could become stale in a matter of a couple of months, but normally for most businesses, 6 to 12 months is about average. Anything more than 12 months and you end up having to spend more money on a brand new valuation, you don't want to do it. So if you want to keep it up, do it frequently, at least once a year, and your costs will be limited. As we move into the next slide, we talk about preparing for listing. Now, we put this slide up because it's critical, and the reason why it's critical is because it's no secret that many, if not all, small business owners do their best to limit their tax burden, and in doing so, small business owners like to run a variety of personal expenses through the company. And obviously, at the end of the year when they're filing taxes, some of that can be included, some of that cannot be, depends upon the CPA and the strategies that you use with your CPA. But in retrospect, value is in fact driven, at least in one part, by risk and what I'll call messy financial statements. And what I mean by that is financial statements that are written with personal adjustments to the income statement, things you run through the business that are not business related, does add risk to the value of the company. So we always suggest, if you are going to list your company at some point and have the time, we usually look at a good solid 3-year period of historical performance. And if you have the kind of time to take a 3-year period and clean your financial statements, that is wisely used, because the cleaner your financial statements are, the less risk you have, and the less risk actually drives your value up. So it's always important to make sure that you do your best to limit the adjustments to your income statement, and better yet, get rid of them all. If that means you got to pay your taxes in full for the next 3 years, trust me, it's worth it. You may not like it going through that process, but a clean set of financial statements, you will get that return back on your tax if you do it right. You don't want to overprice your business either, and that's the other reason why getting a valuation is important, is because that most business owners, again, have an expectation of where they think value is, and 9 times out of 10 that value is over where it should be. There is a process to valuing a company. It's if you have the right experience and know what you're doing, it's not that challenging in most cases. But for somebody who has no idea how value is derived and where value comes from and what variables will drive value to a small privately held company, it can get a little complex. And overpricing business doesn't do anybody any good. It's always important to make sure that you go through the process with an open mind, so that when you establish that value for your company, you can do one of 2 things. You can either list it for sale because it's where you'd like it to be, or you find out that you don't have enough value based on what your expectation was, which means that now you need a couple of years to get things better. And there are value drivers that you can focus on to help increase value, and we'll talk about in a little bit. Those value drivers typically are very minimal in terms of some of the things that you can do. I mean, for example, if if value is driven from profit or cash flow, it's a simple process of either increasing your revenue or decreasing your expenses or both, and you achieve that goal. So it's not rocket science to increase value, but you need to know where those value drivers are, and they're different from one company to the next and one industry to the next. And finally, you want to make sure that as part of this entire process, you want to make sure that you choose your appraiser wisely. There are thousands, if not hundreds of thousands of appraisers around the United States and around the world. All of those appraisers that are qualified to do this work will have a designation as part of their credentials. So you want to make sure that when you do choose that appraiser, you want to make sure of two things. One, that they have the appropriate credentials, and then number two, that they have experience in valuing small businesses for mergers and acquisitions. That's very important. Otherwise, you may get somebody who's not familiar with the nuances of what the market is like and how to incorporate and interpret those nuances as part of the valuation of a small privately held company. So the first thing that you need to understand when it comes to an appraiser and what you are going to get as part of your appraisal is that it's going to represent fair market value. And the reason why we have this here is because there are different types of standards when it comes to valuing a business. Fair market value is the standard of value that is used most often when it comes to mergers and acquisitions of small privately held companies. And when I define small as anything less than $20 million in revenue. So we're dealing with non-public or private-based businesses of all industries and of all types. 20 million or less typically falls into that category. So when you're getting your appraisal done on your business before you list it for sale, that final number is going to represent what we call fair market value. That in terms is defined as a hypothetical transaction where there is a willing buyer and a willing seller, and that's hypothetical willing buyer, hypothetical willing seller. There's no compulsion to buy or sell, and those individuals have knowledge of all relevant facts. Now, the important key to look in all of this is that term hypothetical. The valuation is not going to take into consideration specifics of an individual buyer. And what I mean by that is if you're looking at a particular buyer out in the marketplace who owns a company just like yours that is going to buy your organization or your company for one specific purpose. That could be your customer base, it could be your revenue stream, it could be your market share, it could be your building, it could be any number of things. That is a specific component of the transaction that is not considered as part of a hypothetical fair market value transaction. Hypothetical transaction and fair market value represents the business under current ownership and under current financial structure prior to any hypothetical buyer taking over that business and doing something with it for themselves. So the valuation is going to represent your business as it is today, not what it should look like tomorrow. Always keep that in mind. A lot of business owners get caught up in the types of things that buyers can do that a business owner or the seller has not done yet. So you get comments like, well, I know if a buyer comes in and buys a company, all they have to do is do X, Y, and Z, and they'll be able to profit more from it. I just haven't had the time to do that. Well, a buyer's not going to pay you for that. That's where the buyer's return on investment comes from. So a astute buyer is going to consider only what you have done with your company as of today, nothing going on into the future. So whatever you have in that company right now and however you have performed up to that point is what the value is going to represent. So always make sure that you understand that. That's also part of setting expectations. That expectation comes down to what you've done with it now, not what somebody can do with it later. So when you go into the valuation process, there are different types of valuations, as I mentioned earlier, that will be offered to you from any appraiser that you seek advice from. For most, especially when it comes to the listing process, you don't need anything formal. Calculation report is a common term. A calculation report is something that is minimal in scope and depth. And only provides information that would be considered knowledgeable by an owner and an owner's advisor. So, for example, if you're using Joan's firm to list your business for sale, a calculation report gives you just as much information as you need at that point to list the business before you proceed. The valuation in terms of a calculation report is only intended for you and your advisor. That's it. A summary report is deemed as a more in-depth report. It's intended for multiple users. So not only you and your advisor, but prospective attorneys, consultants, lenders, anybody outside of your internet net circle that you use as part of your advisory firm can see that. So calculation report is brief and less depth. A summary report is lengthy and has more depth. Now, when you look at any one of these reports, the valuation methods are going to be the same, but the approaches to value are going to be a little bit different. And that really comes down to the type of business that you have and what the financial performance of the company looks like. But you need to understand that when you're dealing with calculation reports or reports that are not as brief, or the reports that are brief, you want to make sure that you understand that you're not going to get a whole lot of depth in those kinds of reports. You're going to get the basics. The summary report is going to give a whole lot more depth and understanding as to exactly how the valuation was prepared, the methods that were used and why they were used, all the details and the variables that go into the calculations for those methods. So obviously you get a better sense here when you look at one report versus the other. You're going to have a lot more to read on the summary report as opposed to the calculation report. The difference of the methods that you're going to see are going to be very minimal. Every valuation report, whether it's a calculation or something more in depth, is always going to incorporate three basic approaches to value. That's cost, market, and income. That doesn't change depending upon the report. Any qualified valuation experts can give you the same report with the same methods. It's what goes in the report and the depth, the detail that you get, which will determine the difference between what we'll call a Main Street valuation versus an acquisition valuation. Typically, in the Main Street level, you don't need a whole lot of detail because the most small Main Street companies are less complex. Whereas at the M&A level, where companies tend to be a little bit larger, the financial statements and the aspects of all of those different types of companies tend to be a little bit more complex. The one other thing that you want to remember, too, is that small Main Street businesses are valued like larger merger and acquisition counterparts. The reason why is because Main Street businesses carry a lot more risk because most of the time those businesses are managed solely by an owner-operator, where that owner-operator has the majority, if not all, of the control of the financial performance of the company. Most of the time those companies are not only those owners are the managers, but they're also the key salespeople, and they always do the majority of the marketing and sales as well. Whereas at the merger and acquisition level, there are different people doing those different roles, and generally the owner-operator is either at a very high macro level or the owner is not an operator at all. The owner is absentee and relies on a president or a general manager. So the marketability, what I mean by marketability is marketability references what companies sell for in these two different spaces in terms of multiples of earnings. So Main Street businesses typically carry a lot of risk by themselves already, so the price to earnings multiples are generally going to be a lot smaller than you might see at the M&A level. So anything less than $1 million of cash flow typically is considered Main Street. Anything above that generally is considered M&A. It's not a definition of the differences between the two, but from an appraiser standpoint, that's typically how we define them. There's some gray area there as well, but usually from our standpoint, we start shifting our focus a little bit from Main Street to M&A once you hit that $1 million cash flow mark. Public companies, private companies are not the same, and they shouldn't be valued the same either. So whenever you are discussing value, the counterpart with an advisor or anybody in that capacity, keep in mind that there's no comparison between a public company and a private company. I don't care what you do, I don't care how great the company is. Private companies are valued one way, public companies are valued another. They are not to be compared at all, period. So just make sure of that. And the reason why we bring that up is because that we've come into contact with a lot of people who come to us with that expectation where they've said, look, my company is very similar to the one I just sold, that I saw sold for in the stock exchange. It was trading at 13 times cash flow, and we believe that's what our company is worth too. Well, it's not a direct comparison. There are too many differences between public and private companies for them to be compared at all. So going into the process, you want to make sure you leave anything referencing public companies out of the equation. It's meant to be there, and it shouldn't. So that always helps you understand now that multiples of earnings for smaller privately held companies is where your expectations should be. Well, I'll get to a little bit later. I'll get to some good benchmarks for you to look at to make sure that you understand where you need to be in terms of value to help set a proper expectation. Rules of thumb are a good benchmark, but that's it. They're not part of valuing a company. We have access to a periodical or a book that we call the Business Reference Guide. If you don't have it, it's always good to get one. It's good for anybody, whether you're an appraiser, a broker, a buyer, a seller, business owner. It's a good reference guide to help you understand where value comes from various different industries and the types of companies within those industries. It's a benchmark because you can look up just about any kind of company that you may own or have ownership in, and usually there's some kind of a rule of thumb in there for how to value it. And a rule of thumb means typically some form of a calculation of some general asset or stream of cash flow that the company has. Most of the time, those rules of thumb will be financially driven, so you'll see 3 times cash flow plus 50% of your inventory, or 2 times sales, or 1 time sales plus fixed assets. There are a lot of different ways to value companies from these rules of thumb. But be clear, these rules of thumb are just a guideline. They're a benchmark. That's it. The reason why is because, as we all know, every single company out there is different from one another. Even 2 companies that do the exact same thing can be different financially. They can be different from a volume and sales standpoint, different in terms of how profitable they are. And that profitability is what helps drive that value. So the rules of thumb are just a benchmark. You can be within a certain range, but the valuation of your company is going to help pinpoint what the range is. The value at the end of the day has to make sense. And what I mean by that is, going back to that whole scenario of public versus private, we know that small businesses, privately held companies, don't sell for what public companies sell for. So when you start looking at public company transactions and multiples of EBITDA or multiples of revenue, that doesn't make sense when it comes to private Main Street businesses. So you want to make sure that you eliminate that from your set of expectations. So what are those benchmarks I was telling you about? And the reason why I like to put this up on the screen is because if you're going to try to set some expectations of value, here's where you need to stay within. I'm going to identify 2 primary streams of income. One is called SDE. That's the seller's discretionary earnings. That is basically taking the financial statement of the company, starting with net income, that's pre-tax net income, plus interest, depreciation, amortization, owner's W-2 compensation, and any other non-operating or business-related expenses, what we call add-backs. Once you add all of those numbers up together, you get what's called seller's discretionary earnings. That is an earnings base that is available to a hypothetical buyer before he or she pays somebody to run that business. So that earnings base is basically a company without a general manager, a company without a president, a company without a staffed leadership role. That's what's available to a business owner before he or she pays somebody to run the business. That's just what they're going to put in their own pocket as an owner-operator without paying somebody to run the company for them. Now, when you come up with that figure, 2 to 4 times that number is typically where you're going to be with, and I would say closer to 3 is about the average. Obviously, I know that's in between 2 and 4, but most small businesses sell for roughly about 2.95 times discretionary earnings, so about 3. Certain industries have higher marketability levels, and that means that you're going to creep up closer to 3.5 or even 4. But I think from a realistic standpoint, anything between 2.5 and 3 is probably a very good starting point when it comes to value. That's for small businesses. That's typically with discretionary earnings of about $500,000 or less. Now, once you get above $500,000 of discretionary earnings, now you start looking to EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Essentially what that means is you take your discretionary earnings, which is cash flow available to somebody before they hire somebody to run the company. EBITDA is basically taking that salary for somebody to run the company, and you deduct that from your discretionary earnings base, and what's left is EBITDA. It is essentially your adjusted earnings prior to tax. Those companies that are generating, and I mentioned $1 million of cash flow better earlier. You probably can go as low as 800,000, but I like to look at $1 million. Once you get to $1 million of cash flow, your EBITDA figure really becomes the primary earnings-based focus on when it comes to value. And once you do that, anything between 3 and 5 times that number, again, is a good starting point in terms of setting expectations for value. Once you get beyond about $1.5 million to $2 million, 5 to 7 is probably a more realistic figure. That's when you start getting into middle market and companies that are close to going public. But I would say, at least in terms of our discussion today, 2 to 3 times discretionary cash flow and 3.5 to 5 times EBITDA is probably a good benchmark. I've got one question. It says, is there any difference between what my CPA will say is the value and an appraiser's? It's a very good question. It depends upon what the CPA is registered and qualified to do. Now, CPAs by trade are accounting. They're accounting professionals. It does not make them a valuation professional, not in the least. Just because you're an accountant and you know how to prepare financial statements and tax returns doesn't mean that you know how to value a company. Okay? So unless that CPA has a designation specifically in business valuation, then they are not qualified to issue a valuation at all. More importantly, I will tell you that you don't want your CPA valuing your company anyways. That is a conflict of interest. So the first thing that a buyer is going to ask you when they come in to look at your company is, how did you arrive at your value? And if you say CPA arrived at that value, they're going to walk away.
Absolutely.
It's just a conflict of interest. So you don't even want your CPA to do that. Now, if you want your CPA to help advise you on valuation in terms of how to increase value, nothing wrong with that. That's an internal thing and for management planning only. But we'll still make sure that you understand that your CPA has to have a valuation designation in order to provide you with qualified valuation advice. I've got another couple of questions here. One is value now versus value later. Is there any value to future cash flow? Well, particularly the definition of value is present value future cash flow. So a valuation now should reflect what a hypothetical buyer should be expecting going into the future of the company. Now, there are two ways to value a company. You can base the value off of cash flow, let's say over an average of the last 3 or 4 years, versus cash flow looking forward. Now, what makes the difference between the two? You want to make sure that if your company is steady in terms of cash flow and consistency, then taking an average of the last 3 or 4 years is probably going to be just fine to base the value of the company on. If you've had an event to create something in terms of a change, change looking forward may have an impact on revenue, may have an impact on cash flow, and at that point, looking forward might be the way to go. There are different types of valuation methods to account for those different situations. Typically, capitalization of earnings represents a hypothetical value of a company over the last 3 or 4 years on average, whereas discounted cash flow is a value that represents something looking forward into the future. Most publicly traded companies are valued based on discounted cash flow. Most privately held companies based on multiple of earnings, which reflect an average of the last 3 or 4 years. So what drives value? There are lots of different contributing factors when it comes to valuation. But the two most important ones are what you see on the screen: cash flow and risk. Those are the two primary drivers of value. Everything else is more contributory. That's it. So if you're going to have any impact on the value of your company, there are only 2 ways to do it. That is either 1, to improve your cash flow, or 2, to decrease your risk. That's it. So you can look at industry statistics, you can look at economic presentations of information and how they apply to your company, and you can look at all different kinds of various factors that you believe are important to the value of your company. But what I will tell you as an appraiser is that there are only 2 primary drivers of value, and that's cash flow and risk. You can determine cash flow coming straight from your financial statements. That's it. So once you provide a set of tax returns or a set of CPA audited, reviewed, or compiled financial statements, you can derive and determine and calculate your cash flow from those statements. So you know that. That is a known factor. So you have half of that, or 50% of these 2 variables already done. The other one, however, is a lot more inconsistent consistent because risk is a perception, and perceived risk varies differently from one person to the next. So when you're looking at cash flow, you're looking at normalized financial statements coming from a credible source. When you're looking at risk, you are looking specifically at risk that impacts the company. And that is, as I mentioned to you before, that's different from one person to the next. Risk comes in all different forms. It comes in financial risk, economic risk, industry risk, management risk, dependence on owner risk, concentration of suppliers and customer risk. There's all different kinds of risk factors that an appraiser will take into consideration as part of the evaluation of your company. But I can assure you that all of those factors are going to be looked at, and those factors will be applied in some form or fashion to cash flow as the basis of the value of the company. So when it comes to valuing the company, we're going to talk about the different valuation approaches, okay? And there are 3 of them, and that's it. And any qualified appraiser and any qualified appraisal report is going to give you the same set of valuation approaches. Let me repeat that. It's the same set. There are only 3 of them. We're going to cover them right here. We're going to start with the asset approach. The asset approach is essentially the difference between it's the only approach that focuses on the company balance sheet. It is the most conservative method of all 3 valuation approaches. And the reason why is because you cannot value a company any less than the value of its hard, tangible assets. So consider an idea that you've got a company that has no income but has $1 million worth of assets. On the open market, those assets have value. Somebody will buy them, and you can get them appraised. And you can sell the company for the value of those assets. You can just sell the assets outright. The asset approach does focus on value, but that value is focused on the company's balance sheet. So the only way to make sure that you get the right number to that asset approach is to make sure that you have all of your furniture, fixtures, and equipment appraised. Now, you can estimate the market value of those assets, but to be right and to be accurate, you want to make sure that you have them appraised. You can do that through any certified machinery and equipment appraiser. You're going to remove any real estate assets and liabilities as part of that process because real estate is a separate asset altogether. The appraiser will always separate real estate assets from business assets because they are 2 different things to be appraised separately from each other. So always make sure you remove the real estate assets and liabilities. We call them non-operating assets and non-operating liabilities. That would include any other assets or liabilities that have no part in the company's operation. That could be things like shareholders' personal IRA or shareholder loans or off-book or off-balance sheet liabilities that the shareholder has come in control of. All of those things have to be removed from your operating balance sheet before you can calculate the asset approach properly. So make sure that you remove all of those things, and once you do, you should have a pretty good idea of what the value of your assets are worth. As mentioned earlier, you always suggest that you have your fixed assets appraised. It does assure a high level of accuracy when it comes to estimates. People overestimate their assets too. They tend to think that their assets are worth more than they really are. Once you buy those assets brand new, it's just like any other asset that you buy. On day 2, the value of that asset drops. That's consistent with any business asset as well, so keep that in mind. Generally, when it comes to using the asset approach as part of a business valuation, this approach is only used for those types of companies that are heavily invested in assets. Large companies with significant amount of machinery and equipment, they may be generating a good level of cash flow, but in those situations where you've got, let's say, $20 million of hard assets and only $1 million of cash flow, the value of your company is really going to be tied up in your assets. Typically, you won't see a valuation use this method except for those types of companies. The market approach essentially is the basis of substitution. So you should be able to go out and put 2 companies next to each other and use the information that you get from those comparisons as the basis of what your company should be worth. It's the comparison of like companies. That means size, industry, and structure. Anything that's not comparable to your company shouldn't be used as the basis of comparison. It's pretty simple. Public companies are not relevant as a comparison to a private company. Typically, you'll find that there are only a small amount of databases that are out there that offer what I'll call reasonable amounts of information when it comes to comparable companies that have been bought and sold that you can use as a basis of comparison for yours. The idea here is you're going to go to these databases and you can find whatever you can find. You're going to pull the ones that are comparable. You're going to stick them right next to yours, and you're going to see what they sold for and what they look like financially. So, for example, as an appraiser, what we're looking for is a couple of things when we look at comparable sales. We're looking at obviously what they sold for. We're looking at the size of those companies in terms of revenue volume. We're looking at the size of those companies in terms of asset base. We're looking at the level of profitability and cash flow that those companies have generated and the cash flow margins that those companies reflected in their financial statements. We're going to compare all that information to a subject company, and how that comparison looks will determine whether or not the multiples that were derived from those transactions are adequate in using against your particular company. So, for example, if I'm looking at a company that, let's say, has $1 million in sales and $200,000 of cash flow, which gives your cash flow margin at 20%, no customer, no significant risks in the transaction at all. The company sold for 3 times cash flow or $600,000, and you have a company just like it. If you're generating a level of cash flow that exceeds, let's say, that 20% cash flow margin, it means you're doing better with as much or little than the comparison company. That gives you a little bit of an edge in terms of value. You might see that this company sold for 3, maybe you're worth 3.25, just because you've got a higher level of profitability. That's just one example of many that we like to look at when it comes to comparison of one company to the next. We're looking for a good level of comparison in terms of financial structure and financial performance. The companies that perform at a better level with less in terms of assets or size are going to be valued much higher. Same as those companies that are being used and being sold with very clean financial statements and good cash flow margins. Those are going to be less risky companies, and they're going to command higher multiples in the marketplace. Now, look, the market approach is not something that any appraiser is going to rely on 100%. The reason why is because the databases that are out there don't consume the entire private company transaction market. That's because that these transactions are not supposed to be reported at all. The databases are limited to whatever information is being supplied to those databases used. There are 4 we mentioned here: Peer Comps, BizComps, PratStats, and IBA. Those are the 4 most common databases that are out there for comparable transactions. The Peer Comps database is based solely on FBA transactions. That's probably the cleanest of the 4, but you'll find that BizComps, PratStats, and IBA may have a little bit more in terms of number of comps. But they're all good comparable databases to use. We always suggest that in order to have good qualification of comparison, you need at least 5 comps. And don't cherry pick. That means take the best ones to use with your company. You need to take all of them and just remove the ones that don't belong there. Those are the ones that look out of place. And when you see all the comps that you can pull from these databases, you'll know which ones I'm talking about. The income approach essentially is what we call the principle of expectation. It's based on a couple of key factors, obviously cash flow and then risk. What we talked about earlier is when those two primary drivers come together. Cash flow is your profitability, and your risk comes in the form of a cap rate or your risk rating. Okay? So when you're looking at the value of a company, you're applying a cap rate to cash flow. If you invert that cap rate, it becomes a multiple. So it's the same idea here. It's essentially a multiple of earnings. So, for example, if you've got a 25% cap rate, your multiple is 4. 33% cap rate, multiple is 3. So you get the idea here. It's based on cash flow and it's based on risk. And there are 2 types of valuation methods under the income approach that you may see in a valuation. One is single period capitalization method. That's basically taking an average weighted earnings and applying a cap rate to it. And then your multi-period discounted cash flow, which is what we talked about earlier, taking a set of cash flows going into the future and applying a multiple against that. Neither one of these are better than the other. It just depends upon the situation that the company calls for. As I mentioned to you earlier, capitalization of earnings is essentially taking a weighted average of cash flow. Those are for companies that have a good, solid, steady, consistent way of operating from one year to the next, where there's very little fluctuation in the performance, whereas discounted cash flow is for those companies that are having some kind of a changing event looking forward, whether it be a new product, new market, a new owner, It could be any number of things that you could look to the future for because the current operation is being changed in some form or fashion. Always keep in mind that when you're valuing businesses with long contracts, recurring revenue, recurring service contracts, anything like that, those items are always going to be built into final valuation. They are never going to be in addition to. So with that in mind, we will open it up for questions. I don't know, Joan, do you want to open it up in terms of notes here that we can read or just verbal?
I wanted to take you off mute, so if there is anybody that has a question. Let's see. Okay.
The conference has been unmuted.
So if anybody has a question from what Darren has gone over, we have a few minutes to take those. Just introduce your first name and ask your question, if you would. Hope we didn't totally confuse them, Darren.
Well, the good news is if you're still trying to absorb all this information, because I know we've covered a lot in the last 45 minutes, you've got phone numbers and emails in front of you on the screen there. Don't hesitate to call or email any one of us if you have any questions, whether it be now, tomorrow, or even next week. We're always happy to help you. I personally don't charge for answering questions, so you can hit me with as many questions as you want via phone or email, and I'm happy to help.
Yeah. And typically the valuation, if we take it to a appraiser like Darren, it's anywhere from $2,500 to $6,000, $7,000, just depending on the complexity of your company. If we do it in-house, it's anywhere from $750 to $1,500. But it really does help for the credibility for a buyer when they say, who did your valuation? And if you said, my broker, they still know we know what we're doing, but it's not the same credibility as having an appraiser valuation specialist like GCF. So thank you so much.
Joan, we got one question here. One came in, it says, how does an SBA lender value a business? Seems that they are always low. My response to that is that the SBA lenders don't value companies. They underwrite them for loan purposes.
Right.
They look at a variety of different variables, primarily what they call global cash flow. They are also looking at the risk of the company, but they are looking at cash flow as a whole to make sure that that cash flow can service debt. So that's how they look at the underwriting of a business as it pertains to a loan. Now, having said that, keep in mind that any SBA lender who is going to do a loan is going to be required to have that business appraised as part of that underwriting process. The appraiser is going to value a company. So keep in mind how an SBA lender looks at a company in terms of cash flow and value is very different than the way the appraiser is going to look at it. The appraiser is going to value it traditionally, whereas the lender is looking primarily at cash flow coverage ratios and the company's ability to service debt. And just because a company is able to service debt doesn't mean that that's what it's worth in terms of a purchase price. A lot of companies out there are overpriced a lot.
Right. And so typically, if a buyer wants to look at the seller's SBA appraisal, it's going to probably be quite a bit lower than what we've priced it for. So, yeah.
Well, Joan, it's a different purpose. So it's a more formal purpose. You're talking about a guaranteed government loan. It's a very, very formal purpose. So the cost is going to be quite a bit higher than your traditional informal valuation. And we've got a second question that came in. If the owner company is kept on after a purchase as a consultant, does that factor into the valuation? The answer to that is that the valuation assumes a steady and easy transition between buyer and seller. It does not consider any financial arrangement being paid to the seller by the borrower or by the company in terms of value as part of that transition. It's pretty common that there's a transition period, usually 6 months to a year, and usually that individual is being paid on a consulting contract for that period of time. But that does not factor into the value of the company because the company is normalized cash flow to reflect one owner-operator and everybody being accounted for. The consultant would be considered a one-time or a short-term non-recurring event, and therefore that cash flow expense is not factored in any shape or form into the valuation.
Right. Well, thank you so much. We've come up to our time. So, Darren, I'm sure you might get a few phone calls, and if they call me and I can't answer it, I'll make sure to refer them to you. But hopefully we'll be able to help some of these people get positioned so that we can help them sell their company. So
right,
thank everybody for being here, and please call and let us know if we can help you in any way. Thank you. Bye-bye.